Chapter 12, Real Estate Finance. There are a number of things that we need to talk about regarding financing, and in most transactions, financing will be required. I want to make sure that we know the difference between a promissory note and a mortgage. A promissory note is an IOU. It's a legal acknowledgement of a debt. Now, the promissory note does not require any type of witnesses, nor does it require that document to be recorded. I'd also like to caution you, please don't witness a promissory note, because when you do, you might become legally liable for that note. A mortgage, on the other hand, is collateral. It's a collateral instrument. Remember, it's a conveyance instrument. And all the mortgage basically does is it outlines the rights that lenders have, that if a borrower defaults, that they can take the property and sell it at a public auction to get their money back. I think an easy way to remember the difference between a mortgage and a note: when you borrow money from a bank, you're going to give the bank your property as a hostage. And they're going to hold that hostage until that ransom note is repaid. Once the ransom note is repaid, the hostage will be returned through a satisfaction of mortgage. Here's the catch: if you don't pay back the promissory note or the ransom note, the hostage will be executed by way of a foreclosure. So when you think about a note and a mortgage, just think that it's your property is being held as a hostage. You want to get it back, pay out the note, get it back. There are a number of important clauses that we have contained in mortgages. Another important clause in your mortgage is the acceleration clause. The acceleration clause allows the lender to accelerate the entire debt in the event that the borrower defaults in some way. I think the easy way to remember this is that you can't foreclose on something that's not delinquent. Therefore, in order to make the entire loan delinquent, it has to be accelerated and called. The two types of theories in lending is lien theory and title theory. I think that most states have already converted to a lien theory state. That is to say that when you borrow money from a bank, you're simply going to give the bank the property as collateral. The homeowner retains legal title. For a while, there were states that when you borrowed money from the bank also wanted legal title to the property, retained legal title until the property was paid off. Fannie Mae and Freddie Mac, I believe, the way that the mortgages and notes are designed today, most states have converted to a lien theory state. As far as mortgage assumptions are concerned, we don't see a lot of assumptions in mortgages today, but there are two types that we're going to need to know for testing purposes. Your standard mortgage assumption. And what happens in your standard mortgage assumption is that a borrower comes in and says, I'd like to take over the payments of your loan. It's going to be okay, but remember there's a due on sale clause that's going to require that new borrower, that new buyer, to come in and qualify with the bank and sign off on a promissory note. That's how it's typically done. Many years ago, we had something called non-qualifying assumable loans with the FHA and VA. And what happened there was that a borrower could come in and take over payments but never become liable for the debt. In other words, they never signed a promissory note. Those were very dangerous for sellers because in the event of default on the new owner, if there's any deficiencies, it would come back to the previous owner. Priorities in mortgages. Just remember that the priority list in a foreclosure or at the public record, whoever records first on public record is always going to be in a senior position. There's only a couple of exceptions, usually real estate taxes, special government assessment taxes, income taxes, those kinds of things will always be superior. But by and large, it's when you record a document. Now, anytime that one of the lenders would like to take a superior position over another that's already recorded, it's going to require a subordination or a subordination release to be able to move above someone else's position. Foreclosure is a judicial process, as I mentioned earlier, that's part of the mortgage package, that if you don't make your payments or you default in some manner, the bank has the ability to go in and say, you know, we want to go ahead and take the property, sell it in a public auction, get our money back. The first step in any foreclosure process after acceleration is going to be a les pendens. That's an official legal notice on public record that a lawsuit has begun. Now, I also want you to remember that the property owner has a right to redeem themselves up until the foreclosure auction. That process is known as the equity of redemption. The equity of redemption is that time period from the time the foreclosure begins until the public auction to redeem themselves. Now, the primary sources of mortgage money today, we have a lot of sources. Savings and loans are actually still pretty big business. Commercial banks, credit union, but probably most of our money today is coming from mortgage bankers. I want you to know the difference, though, between a mortgage banker and a mortgage broker. A mortgage banker is a company that actually lends money. They can make loans, they can approve loans, they've actually got the funds to do it. Mortgage brokers, on the other hand, are companies or individuals that have sources of funds that they can go to, and when they have a borrower, they put those funds together with the borrower for a fee. Mortgage brokers can't make loans. Mortgage brokers can't approve loans. They have to send them off to whoever that investor is that's going to make that loan. Life insurance companies have also become a very big lender of large-scale commercial properties. I know that when we did Gulf Coast Medical Arts Complex, a life insurance company financed that for us. They were very easy to work with because they have a lot of liquidity, plus they're not regulated by the federal government. They're only regulated in the states that they do business. There's also private funding out there. You'll be surprised how many companies or individuals are willing to buy mortgages today. Let's talk about the Federal Reserve Bank. A lot of people don't understand what the Federal Reserve Bank is and what its real role is with the way we do business. The Federal Reserve Bank was created actually in 1913, and it's interesting to understand where it came from. J.P. Morgan, John Rockefeller got together with the Rothschild family out of Europe and a number of other large banking families and created the Federal Reserve Bank. It's a private corporation. Today, its job is to be the monetary maker or policy maker of our money supply. The United States, obviously, is the money supply for a lot of countries throughout the world. The Federal Reserve wants to make sure that we don't have too much inflation or too much recession. They want to keep everything on a balanced playing field. There are three ways the Federal Reserve can influence the cost of money. That's interest rates. One is the change of the discount rate. Now, the discount rate is the interest rate that the Federal Reserve charges participating banks to borrow from them. In other words, a local bank can either borrow from us through our savings accounts, or they could borrow from the Federal Reserve Bank, whichever gives them the least rate. For many, many years, the Federal Reserve rate was at 7%, and our savings accounts were at 5%. So they had rather borrow from us than the Federal Reserve Bank. And that's why they were giving away a lot of toasters and lamps to get our money into the savings system. Today, interest rates for the Federal Reserve, the discount rate is sitting at about 0.5%. Therefore, our interest rates in our savings accounts are about at the same place. So there's really not a lot of flexibility anymore. It's easier to get money from the Federal Reserve being charged that discount rate. Remember that as discount rates go up, interest rates typically go up. As the discount rate comes down, interest rates typically go down. Another way that the Federal Reserve can influence money is through the reserve requirement. Now, this is the amount of money that banks have to maintain after taking our savings and checking. In other words, they're going to take our deposits because they're intermediaries. They're going to take our deposits and typically invest it somewhere. Well, the Federal Reserve says, wait a minute, you can't take it all, that you got to leave a certain amount in there just in case of an emergency. At one time, that reserve requirement was at 15%. It got down to as low as 3% in about 2004 or 5. They recently raised it back up to about 8%. Now what is happening is banks are having to get that reserve up before they can make loans again. So that reserve requirement is a very important key part of lending. As that reserve requirement goes up, the less money that's in the system for them to lend out, which means interest rates typically go up. So as reserves go up, interest go up. As the reserve rate comes down, interest rates typically go down. Now, the best method that the feds have to influence long-term real estate interest is the open market operation. And that's simply the relationship that the Federal Reserve Bank has with the United States government and other countries borrowing money out of that system. In other words, the Federal Reserve lends money downstream to commercial banks and other banks. At the very same time, the United States government and other governments are borrowing out of that same system. As they borrow out of that system, it depletes the funds available for local banks, which typically cause interest rates to go up. It's supply and demand. The less money available, the more it's going to cost. So the bottom line is that as the United States government pulls money out, interest rates go up. If they put money back in, interest rates will go down. So the open market operation is just simply the relationship that the Federal Reserve Bank has with local banks, the U.S. government and other banks, and the amount of money that's in that system. They want to make sure they have enough in there that's available for both parties, but at the very same time that we're not printing too much money to cause the value of the dollar to decrease. The secondary mortgage market, this is where mortgages are bought and sold. The United States has three primary secondary market functions. Freddie Mac, Fannie Mae, and Ginnie Mae are the three. So let me start out with Fannie Mae first. Fannie Mae was created in 1938 to purchase the FHA insured mortgage. Today, Fannie Mae purchases all three mortgages. In 1968, Ginnie Mae was created as a subsidy program to work in tandem with a tandem plan to do subsidized loans with Fannie Mae. In 1970, Freddie Mac was created to purchase conventional mortgages from savings and loans. Today, Freddie Mac buys all three. So Fannie Mae and Freddie Mac basically compete with each other. They buy FHA, VA, and conventional loans. Now remember, Fannie Mae was created to purchase the FHA insured mortgage. Freddie Mac was created to purchase the conventional mortgage. Let's take a look at the three types of mortgage markets that we have right now. We have the conventional mortgage market, we have the FHA, and we have the VA. The conventional mortgages come from the private sector. Today, the down payment is going to be a little bit more than your FHA and VA. The qualifying ratios are going to be a little bit more strict. And also, there's going to be private mortgage insurance on the loan amount that's above the 80% loan-to-value ratio. FHA is an insurance program. FHA does not make loans. Now, FHA does have loan limits in every area. Every market has a different FHA loan limit. The FHA insurance is paid up front and also monthly. The qualifying ratios for the FHA, your housing expense ratio should never exceed 31% of your monthly gross income, and your total obligation should never exceed 43% of your monthly gross income. VA is a guarantee. Now, for a VA guaranteed loan, this is for veterans. There are no loan limits, but there are some guarantee limits. $417,000 is the most that a veteran can borrow to purchase a home with nothing down. Anything above $417,000 will require 25% down payment on that amount. The guarantee is based on the loan amount. Repayment method, we have a fully amortized loan, we have partially amortized loans. Remember that in a partially amortized loan, typically speaking, there's going to be a balloon payment that's going to be required. The types of mortgages, the adjustable rate mortgage, that's made up of an index and a margin. The index may fluctuate, typically annually. The margin, however, is the profit and it'll stay consistent. The purchase money mortgage is a mortgage typically thought of as seller financing, but actually a purchase money mortgage can be any type of financing dealing with residential real estate or any type of real estate. A blanket mortgage covers more than one parcel of real estate. A lot of developers use a blanket mortgage. In other words, they buy a large tract of land under one mortgage, they go in, they subdivide it, and then sell off individual lots. Well, in order to sell off those individual lots, there needs to be a release clause provided in the mortgage to sell those individual lots. A package mortgage, we don't see those very often anymore. That's when you're pledging both real property and personal property. Federal laws regarding lending. The Equal Credit Opportunity Act has to do with financing and credit, and what it basically says is that lenders cannot discriminate because of race, religion, age, sex, marital status, national origin, or public assistance. The Consumer Credit Protection Act, which is also known as the Truth in Lending, says that lenders have to disclose to potential borrowers the true cost of borrowing, and that's expressed in the annual percentage rate. The Truth in Lending is regulated through Regulation Z of the Federal Reserve Bank. RESPA, the Real Estate Settlement Procedures Act, is also a disclosure. And this says that lenders have to disclose a number of things. One, an information booklet on borrowing. Second, the good faith estimate of closing cost. And lastly, a HUD-1 settlement statement no later than closing. Now, if a borrower requests, they can receive that HUD-1 settlement statement at least 24 hours prior to closing. Let me remind you that all of these legislations that I just spoke of only have to do with residential real estate and any time that we're dealing with a federally related loan. Loan underwriting, all loan underwriting is risk evaluation. And what the lender is going to do is they're going to evaluate the individual. They're going to find out if that individual has the ability to repay. And they're going to look at a number of things. First of all, credit history. Credit history is going to tell you all about the willingness and attitude. In other words, has that person paid back their loans in the past? Also, they're going to take a look at the ability, and that has to do with their assets and income. They're also going to look at the property. They're going to evaluate the property to make sure that it is a good asset to be able to collateralize as part of this loan. The bank is typically going to look at the loan-to-value ratio to make sure that everything falls into place. Once they get through underwriting, once they get through evaluating the individual, and once they get through evaluating the property, at that point, then they're going to make a loan commitment of some type. That commitment could either be a firm commitment or conditional, but they're going to make some type of commitment. The loan could be rejected. Before we leave this section, let me make a comment about discount points. It's going to be important for you to know how to calculate discount points. All discount points are prepaid interest. For every discount point that a lender charges, it's going to increase the lender's yield by 1/8 of 1%. That's as far as the lender is concerned. As far as a borrower is concerned, when a borrower has to pay points, 1 point equals 1% of the loan amount. And you're going to have to know how to calculate one of those on both my examination and the state examination. And that's about all there is for Chapter 12. What I'd like to do right now is review with you Chapter 12 to make sure we understand those most important concepts. The note is a legal acknowledgement of a debt. The mortgage is collateral. Prepayment without penalty is allowed unless the mortgage calls for it in the contract. The buyer is liable for the debt in an assumption unless the bank gives that person novation. Remember that novation is a release of liability. Exculpatory clause is a non-recourse provision for borrowers. In other words, the borrower is not responsible personally for the debt. Subordination allows junior liens to take priority over higher positioned liens. The Federal National Mortgage Association, better known as Fannie Mae, was created in 1938 to buy the FHA insured loan. Today, Fannie Mae buys FHA, VA, and conventional loans. The Government National Mortgage Association, Ginnie Mae, was created in 1968 to provide subsidy funding. Works with Fannie Mae in a program called the Tandem Plan. The Federal Home Loan Mortgage Corporation, also known as Freddie Mac, was created in 1970 to buy conventional loans from savings and loans. Today, Freddie Mac buys FHA, VA, and conventional loans. The Federal Housing Administration, FHA, this is a government insurance, and the insurance premium is paid once up front and then monthly as part of the mortgage payment. The qualifying ratios are 31% for your housing expense ratio and 43% for your total obligation ratio. The Veterans Affairs, or the VA, this is a government guarantee. The total obligation ratio is 41%. There is no housing expense ratio. Its guarantees is based on the loan amount. The conventional mortgage has private mortgage insurance on that amount of the loan above the 80% loan to value. Its ratios are 28 and 36. That is 28% housing expense ratio and 36% of your total obligation. A blanket mortgage covers more than one parcel of real estate and requires a release clause to sell individual lots that are covered by that mortgage. The Consumer Credit Protection Act, the Truth in Lending, disclosure of the APR within 3 business days from application. Real Estate Settlement Procedures Act, this is known as RESPA, information booklet and good faith estimate within 3 days of the application, and the buyer can review their settlement statement at least 24 hours prior to closing if requested. Otherwise, it should be delivered on the day of closing. A credit report shows the willingness and attitude to repay a loan. Discount points are prepaid interest paid at closing. The buyer can deduct from the taxable income their points regardless of who pays the points at closing. A point is calculated as 1% of the loan amount. Each point charged increased the lender's yield by 1/8 of 1%. And that's all we have to review for Chapter 12.